Let me go to Vince. Vince is calling us from Texas. Hey, Vince.
Hi, Dan. Thanks for taking my call. I
Sure
spoke
thing.
to you a few months ago, and I was telling you that I was one of those people who, after the last crash, I stayed out. Right now, I am within a year to 3 years of retirement, and on our last conversation, you had mentioned that for someone in my position who hadn't been in the market since 2008, at that time, it was not a good time to get back in. I've been listening to you since, and you've been saying that though you don't agree with QE, you're kind of resigning to yourself that this is the way it's going to be, and you're asking your members to go ahead and exercise caution, but go ahead and start getting back in. I wanted to know, does that also apply to someone in my situation here who is so close to retirement and has not been in the market for a substantial period of time?
Yeah, great question, Vince. Let me ask you this. Let's say a year from now, year and a half from now, you fully retire. This money that you're talking about, how much of that are you going to be dependent upon to supplement your income?
Well, I'm not sure I know how to answer the question. The due diligence that I've done up to now has gone ahead and said that we're going to try to leave the big stuff untapped, and we're going to go ahead and just live on some savings that we've put aside in addition to what's in the 401k and in addition to what's in the pension. So right now the idea was to withdraw just maybe 4% or so for a short time until we deplete our cash savings. And then we start going ahead and drawing down. We were going to go ahead and put off Social Security until 70 and move on from there.
Okay. I would say I would be okay with you taking a look at 40% of what you have. No more than that. Absolutely no more than that. But I would look at 40%. And it sounds like you're a partner with me on the website. I'd look at some of the things on my buy list for the long term. And I might be okay with you, diversifying 30-40% of that into those. With the idea, and this is so against my grain, but I'm going to say it anyway, with the idea of watching it very closely, or at least paying attention to my alerts, and if I say to sell, that you're able to do that. But I do think that based on this lunacy of the Federal Reserve and the continuation of the trashing of our dollar and printing money and so on, that it is likely, as irrational as it is, the markets are going to continue to go up, maybe through the first quarter of next year. And I would probably take a look at that and say, I'd be okay putting 30 to 40% of that at work. Now, I'm saying that knowing that the stocks on my list are very, very large company, solid stocks. It's not likely that there's going to be dramatic swings one way or another, either up or dramatically down. But I would be okay with that based on what you've told me that your plan is. Because when you look at it with your plan in mind, that tells me that 30 or 40% that you may begin to start committing is going to be basically long term. I mean, it's going to be 6, 7, 8 years before you might get to the point where you need that. So that's kind of how I feel about it now, Vince. But let me just say this too, because you bring up a moment that I don't want it to go by, because it's a bit of a coachable moment here. And when you say that, well, we've decided we're going to let the big stuff generally with most folks is their 401k. Let that sit, and we're going to use some of our savings to supplement our income. I just want to point out that I always like to remind people that once you're retired, to try to leave alone your savings, the money that is outside of qualified money. Qualified money being IRA, 401k, 403b, any kind of retirement money. And I would rather you use your retirement dollars, because as you get older and you use that money, I would rather see you begin to deplete those accounts and grow your savings. Because someday, when both of you are called home to be with the Lord, that you're going to have an estate that is going to get that money. And I would rather that estate get the savings money, more of the savings money than the 401k or IRA money. I would rather you also pay your taxes. This is now, we're talking about 2 years from now, pay your taxes at whatever those taxes are going to be 2 years from now. Because in my opinion, based on where things are going in the markets, we're seeing taxes will get out of control and continue to get up to the point of where we look like Europe or worse than Europe, in the sense that we're going to be paying a significant amount of our income, earned or otherwise, for taxes. So you may be in the cheapest tax bracket you're ever going to be in. So you can't avoid the taxes on that qualified money, and taxes are likely to go up. So I'd rather see you use that, as hard as it is to write that tax check to the IRA. I would rather see you use that. So I just throw that out there as another another point as well, because we need to get some of us need to get out of that mindset that we're going to hold on to the qualified money. I'd rather spend the qualified money, hold on to the other money for the long run. Okay?
Well, with regards to the taxes, I'm wondering here, with the government going in the direction that it appears to be going, these guarantees of these Roth IRAs and so on and so forth, where you pay the taxes up front and, as you withdraw, there are no taxes on it. I think to myself sometimes, with a government that really has no standard anymore, what is to prevent the government at some point of just saying, you know what, all bets are off, we're changing the rules on everything here?
Absolutely nothing, Vince. Nothing is to stop them from that. There is nothing that would stop them. And you bring up a very good point that, I talk about often. The fact of the matter is, I love Roth IRA accounts that they're growing tax-free. But I believe this, that at some point in time, the government's going to wake up to all the tax dollars they're losing. And they're going to do one of two things. They're either going to do away with Roth IRA accounts altogether and grandfather, my hope would be, that they would do the ethical thing, which is, again, I know I'm probably living in some sort of fantasy world right now, but do the ethical thing and grandfather those in to continue to grow tax-free, but do away with the accounts altogether so people can't start new accounts. But we know that we can't expect anything out of this government, and it wouldn't surprise me if they said those Roth IRAs are now going to be treated just like every other IRA account. And, it's going to get reduced in a tax standpoint, but we're going to tax those too, the earnings on those, either with capital gains or income tax, one way or another. So I wouldn't be surprised to see that happen. So you bring up a good point, Vince.
Dan, thanks for all your efforts.
Nothing's
we
safe.
Appreciate it.
You're welcome. Thank you. I appreciate it, Vince.